Hello and welcome to another deep value video. Today, taking an in-depth look at TELUS Corporation, ticker symbol TU. We'll dive into financial metrics, assess the company's growth, and ultimately try to find its fair buy price. TELUS Corporation, also shortened and referred to as TELUS Corp, is a Canadian publicly traded holding company and conglomerate headquartered in Vancouver, British Columbia, which is the parent company of several subsidiaries. TELUS Communications Incorporated offers telephony, television, data, and internet services. TELUS Mobility offers wireless services. TELUS Health operates companies that provide health products and services. And TELUS International operates worldwide, providing multilingual customer service outsourcing and digital IT services. The stock is priced at $15.1 with a market cap of 22.6 billion. Now let's add some key valuation metrics. The price to earnings ratio stands at 39.1 and the price to cash flow ratio is 6.24. The median PE over the past 10 years was 20.1, so they're trading at twice the historic average. Over the past 5 years, the company's revenue has grown by 34.4% and its bottom line has decreased by 52.8%. In terms of earnings per share, there has been a decline of 60.7%, and notably the number of common shares outstanding is 1.47 billion, a plus 22.5% change over a period. Now let's assess the company's liquidity and solvency. The interest coverage ratio is 2.37. Now this is a huge red flag. Of course, they probably are praying right now for interest rates to drop because if they don't, they have a big problem on their hands. A 2.47 interest rate coverage ratio calculated by dividing EBIT and net interest expenses is horrible. This is pretty close to bankruptcy. Usually, bankrupt companies have somewhere in between one and two. For example, when Pennsylvania Railways, I think, merged, I think 50 years ago, I don't remember, it was in the Intelligent Investor book, it had a interest coverage ratio near to 1.8, 1.9, and a lot of people thought that they were safe, but in fact, because their interest coverage ratio was so small, they had to go bankrupt and no one expected it. So they must do something to reduce interest rates in Canada, or otherwise they are kind of uh, in a tough place. The quick ratio, a measure of the company's short-term equity, is 0.47, which is good. This suggests a good short-term ability to handle shocks. And additionally, the long-term debt-to-equity ratio is 1.3, and the total debt-to-equity ratio is 1.56. This is probably where the problem is with that long-term debt. Shifting to our cash flow statement, cash from operations stands at 3.4 billion, reflecting a growth of 12.3%. Cash from investing activities is minus 3.6 billion with a minus 7.7% change, while financing activities are at 100 million, showing a minus 89% change over the same period. CapEx has increased by 5.6%, and free cash flow has grown by 31.9% to 985 million. Moving forward, let's look at the return metrics to see how the company is utilizing these resources. The return on equity is 4.5%, the return on investment is 5.9%, the return on assets is 1.36%, and the return on invested capital stands at an appalling 3.5%, which is less than their weighted average cost of capital, which is 6%. So that's kind of bad. Finally, let's find acceptable buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 9%, a revenue growth rate of 4% for 10 years, and a perpetuity growth rate of 2%, we get a fair value of $8.09. Secondly, using a multiples valuation of 20 times earnings, operating cash flow, and 25 times free cash flow, we get a fair value of $24.3. Finally, the target price is $17.61. Putting it all together, we get an intrinsic value of $16.7, and using a 15% margin of safety, we get an acceptable buy price of $14.17, suggesting that the stock at current levels is close to fair value. To wrap up my analysis, I rate Telsus as a hold. Now, why? Well, I don't think this is a buy, and I think that their real buy price or acceptable buy price would is not even a question at the moment. The real buy price will is not something that I'm willing to give because they are literally uh, a few billions in debt more, close to close to bankruptcy. Because if they had, for example, 4 billion more in debt, which of course will increase their interest even more, they will tip over this cliff where their interest coverage ratio will not be sufficient. It will be in close to 1.6, 1.7. Um, Now, if hypothetically they manage to gather debt on hold and interest rates drop in Canada, then they might increase their interest coverage ratio to about 3.54, which is much more okay. If they manage to do that, then my recommendation would be a buy at about $10 to account for this risk, for this very huge risk, where you basically need a 15%, 50% margin of safety. I know it's huge, but it's kind of necessary in this scenario. Um, for now, I rate it as a hold. If you bought it today, for example, I'm not sure if you should sell it, so I'm not going to rate it as a sell because after all, it's trading below fair price, fair value. Uh, This is just too risky for me, but as I've said, if you are willing and if you just bought it, then sure you can hold it. But if you have not bought it and you are looking at it, I suggest you try and look back in a couple of months or in a year or two when interest rates have dropped and they are in a more manageable position. Now, thank you for watching. If you found this video helpful, please like and subscribe for more deep analysis, and see you in the next video. Bye.